Good Monday afternoon to you. Welcome to the Jon Sanchez Show on News Talk KOH. Pleasure to be with you, and a pleasure to actually say there's green showing up on my computer monitors. That's right. That means it was a positive day today. Finally, we got some positive news today, resulting in some, I won't call them stellar, but hey, you know what? In this environment, we're going to take any gains that we possibly can get our hands on, that's for sure. And we did get those. So I am, of course, going to give you all the updates of what drove this market higher, tell you what happened with the oil side, which is, you would probably imagine, oil was an ally to the stock market today. Little war term there for you. Going to get into some big movers that we had today, some news coming out of NVIDIA, some news coming out of Meta, give you all the updates of what really moved the markets today, and then I'm going to get into a really great topic for you. You know, most people think that retirement planning is about hitting that magic number, right? It used to be, I remember years ago when I got started in this business, it was like, if you had $1 million when you retired, you were considered filthy wealthy, right? That money, you could go do whatever you wanted to do. You could party hard. You could go buy things, travel, do whatever you wanted to do. Now it's like most people go, $1 million, that's all you have for retirement, right? The mindset shift has changed dramatically. But whatever that, magic number is that you think in your mind that you need, I'm going to correct you just for a little bit. Because the real question isn't how much money you have, million, 2 million, 500,000, whatever that number is. As I've emphasized so many times over the years, it's how much income that money can produce for you and your family for the rest of your life. So today what I'm going to do is I'm going to break down the math behind the retirement income and why having a large nest egg doesn't quite necessarily mean that you're going to be ready to retire. No, we want cash flow. We'll talk about that reason why here in a moment. All right, let's get down to the market. So last night, futures were coming down. Oil went back above $100 a barrel. Today, Scott Bessent, our Treasury Secretary, went on CNBC and said, hey, things are just going fine. I don't know what everybody's worried about. He said, you know what, the U.S. is currently, not going to, but currently allowing Iranian oil tankers to pass through the Strait of Hormuz. Now, let's go back to last week on Friday. I think it was Friday or Thursday. The president indicated at that point there was about 125 million barrels of oil sitting offshore in Russian oil tankers. Remember, I joked on the show, I said he, quote, approved other countries for getting some of that oil. Now, you would imagine many countries came unglued on this. Like, wait a minute here. You have all these sanctions against Russia. Look at what Russia has done to Ukraine and the thousands and thousands of people that have been killed. And you're giving your approval that the rest of the world, meaning most likely China and North Korea and many others that are not our friends in some situations, they're able to go get that oil off those Russian oil tankers. And the response was, yeah, because someone has already paid that tax and paid Russia before that oil left the oil terminals in Russia. So that's where this whole international thing kind of started. Now we fast forward to Bessent's comments today. The U.S. is now allowing Iranian oil tankers to pass through the Strait of Hormuz. As soon as that news hit the wire, and that was in the pre-market session, we immediately saw oil prices begin to tumble and the stock market begin to rise. Matter of fact, we're up almost 400 points, about 357, right before the stock market opened on the Dow futures. Nasdaq's were up 300, S&P's were up about 71. So it looked like it was going to be a strong start to the day, and indeed it was. Then, adding to the downturn in oil prices, the Wall Street Journal reported today that the U.S. is going to announce a coalition of countries to escort ships through the strait. Now, later today, the president indicated that this coalition isn't quite ready. It's not really put together yet. And he put out a plea over the weekend that, look at the world, you need to come to our help as an ally, and you need to help us escort ships through the Strait of Hormuz. Well, that's not going too well at this point. I want to share with you this Wall Street Journal story because, as you will hear here in a second, let's just say a lot of countries are not too keen on doing this. So President Trump is pressuring allies to help reopen the Strait of Hormuz and relieve pressure on the global economy. So far, most of them are not biting. Germany has rejected taking part. Japan and Australia have indicated that they're unlikely to send vessels to help. Britain and France said they're assessing possible action, but they haven't committed to doing anything before the fighting halts. Of course, all of these are close U.S. allies. This morning, German Defense Minister Pistorius, he dismissed Trump's call for help, asking rhetorically what Trump expects, quote, a handful or two handfuls, that doesn't make sense, but it says, quote, a handful or two handfuls of European frigates to accomplish in the Strait of Hormuz that the powerful U.S. Navy cannot achieve on its own. He says, this is not our war. We did not start it. Trump sent a pointed message over the weekend to the allies, as I said. If countries refuse to join the effort to open the Strait of Hormuz, quote, we will remember. That's what he told reporters on Air Force One over the weekend. He said in an interview with the Financial Times that if NATO doesn't help, it will be very bad for the future of the alliance. White House Press Secretary Carolyn Leavitt said today that Trump, quote, continues to speak with our allies in Europe and is calling on them for support. Now, Tehran has threatened, of course, to attack any vessel trying to cross without its approval. About 20%, as I just say almost every day, about 20% of the world's oil supply passes through the strait. At least that it did before the war started. I love this comment from Andreas Craig, an associate professor at King's College London School of Security Studies. He says, Trump's been trying to weaponize interdependent using American economic power to coerce partners and allies into doing his bidding. None of Washington's traditional partners can afford to entirely dismiss White House pressure. European countries are still trying to keep Trump engaged in Ukraine and prod him away from U.S. realignment with Russia out of fears it would undercut Kiev's sovereignty and help relieve economic pressure on the Kremlin. So you get the gist of this. This isn't going well, unfortunately, for the president. Now, when I saw the calls for the alliance, and over the weekend, and he said it's not going to end well for you if you don't participate. I started thinking to myself, how many of these countries? This is going to be a tough position for those countries to be put into, because they're what at him right now because of all the tariffs and the mess that he has caused with their countries. And now he's saying, I want you to come to our rescue. And then like the German defense minister said, look, it's not our war, it's yours. You started this thing. But at the same time, I think Trump's got a lot of negotiating power because guess what? Every single country in this world, ally or not ally, needs oil to operate and to survive. Then my mind went down the path of, similar to what the European defense minister said also, what's this really going to do? So put yourself, think about this for a second. Put yourself in, let's just pick Europe, in Europe's position. Okay, so you send a bunch of frigates. They're going to work in conjunction with the U.S. Navy. But what assurance do they have that they're not going to get hit with drones and everything else that our Navy's, of course, very susceptible to? You don't really have any. But at the same time, the ethical question is, do they have a responsibility to come help, since, of course, they need that oil coming through the strait? The other side of that is, like I said, or like he said, this is Trump's war. It's not Europe's war, or Japan, or anybody else's. I mean, think about this for a second. Japan and Australia, they're not sending anything. Britain and France, those are two very strong allies, said they're assessing possible action, but they're not committing to doing anything before the fighting halts. So this could, essentially alienate us from many of our allies that, quote, are already very upset at us because of the tariff situation. So I think it's going to be absolutely fascinating to see what happens over the next few days, few weeks, and see what countries really do come to the rescue of the United States. Or are we going to end up doing it all alone? If we do it alone, or if you don't participate, what is going to be the repercussions from the Trump administration against your country? But I was shocked when Japan said they weren't going to do it. Britain and France basically are just assessing it. This is very serious. I mean, we could end up doing it all on our own. And then, like I said, what are going to be the repercussions if that happens? So that was the big headline over the weekend as well as today. But the bottom line is all we care about is it drove oil prices down and it drove the stock market up. I'll give you the details when we come back. Let's turn it over to Kristen Snow. She's in the Right Now Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on News Talk 780 KOH. I'll be getting to our topic, how much income do you really need to retire, here shortly. But first, let's get you an update on the movers of the day. First of all, let's hit the market overall. 8 gain on the Dow is how we finished up, 0.83% to a close of 46,946. Nasdaq rose 267 points, 1.22%. S&P gained 67 or 1.01%. And the Russell 2000, which was leading the pack earlier, a 0.94% gain, up 23 points. So I guess you could say stocks kind of hitched a ride on an oil tanker today. Oil fell $5.26 a barrel, $93.95. Again, overnight we did touch over 100. And gold for the day was down $61.40, closing at $5,000.30 an ounce. Big pullback in bond yields, down 7 basis points on the 10-year at a yield of 4.22. So everything moved nicely the way it should. Gold down, bond yields down, oil down, stock market up. That's the way it should be. So let's take it for what it's worth at this point. All right, let's go to some of the movers. We had a lot of activity going on with underliers today of the market. We'll start with NVIDIA. Nice move on the stock today, $2.94 rise, 1.63% to 183.19. That garnered not only move in that name, but other semiconductor names that I'll share with you in a minute. And here's the reason why. NVIDIA hosted what's called their GTC conference. Jensen Huang, of course, the CEO of NVIDIA, said that, in his keynote speech, I should say, that last year he saw $500 billion of purchase orders of their very popular Blackwell and Rubin chips by 2026. He says he now sees at least $1 trillion of the aforementioned chips by 2027. So think about that for a second. From $500 billion to $1 trillion, just in chip sales. Unreal. So that drove the chip names up, the memory storage names specifically. We had SanDisk rising $42 and a penny, 6.35% gain to $703.63 a share. Western Digital rose $13.92, 5.11% to $286.21. And Micron up $15.67, 3.68% to $441.80. Amazing. All of a sudden, everybody loves chips again. All right, let's go to the other news of the day. Meta. They announced this early this morning. Stock just rocketed today. $13.74 gain. Not a huge percentage rise, 2.24%, $627.45. But here's the reason the stock took off. Speaking of AI chips, Reuters reported early this morning the company is planning on laying off up to 20% of its workforce as AI costs rise. So I had to do a little bit of math on that. So, okay, here we are. 20% of their workforce. So what that equates to is this. They had a little over 76,000 employees at the end of last year. So ran the numbers, and that's going to equate to a little over 15,000 people are going to lose their job at Meta. Think about that for a second. 15,000 people. And from what I understand, a lot of those people work in the AI department. Now, here's an interesting thing I think no one's really thinking about on this. Okay, so what they said again, lay off up to 20% of the workforce as AI costs rise. Now, we have not seen that comment from any other companies, right? All the speculation, all the concerns before the war started were all about AI spend, the CapEx spend. All these companies, Oracle and everybody out there, the billions or sometimes hundreds of billions of dollars, Amazon, throw them in the mix, that they're spending on AI. No real return yet. I mean, they're getting some, but nowhere near what they've invested. But here you get Meta saying, look at our AI costs are on the rise. And so we got to start getting rid of people. This is what I've been calling for. You're going to see this over and over again. Remember my call earlier in the year? I said, don't be surprised if over the next 1 to 2 years, we see our unemployment, which is hovering right around 4% and some change, to run up to 6, 8. I could see it even as high as 10%. I think when all this AI build out is done, I think it's going to be a norm. No longer is the norm going to be, normally we're right around the 3% mark on unemployment historically. I think the norm is going to be around 10%. I really do, because of AI. So there's news there on Meta. Let's go to Amazon. $4.07 rise today, 1.96% to $211.74. That was after stock moved to a session high, by the way, after Jensen Huang said OpenAI will be brought to AWS, which is Amazon's web services, the cloud division. We saw a good move today in some of the travel stocks. Norwegian Cruise Lines, again, this is all attributed to the fall in oil prices. Norwegian Cruise Lines, which has been beaten and battered lately, rose 98 cents, 5.17% to $19.84. The airlines were strong performers. I just picked United Air as one, up 4.25%, $3.68 gain there to $90.28. Now, who were the losers today? So remember, you've seen Mosaic and CF Industries just tearing it up these last few weeks as the war's been going on. Those are chemicals like Mosaic specializes in farmer fertilizers and many other things similar to CF Industries. They were, and a lot of that comes through the Strait of Hormuz, so there's a point I'm getting to. So those stocks rose, these last few weeks, thinking that, again, no one's coming through the Strait of Hormuz, so their inventories, of course, should be worth a lot more. Well, now that there's talk of other countries helping us and getting the strait open, then you saw these names come down. So Mosaic was down 5.6% today, $1.64 loss to a price of $27.67. CF Industries falling 5.56% or $7.20 to $122.37. And the last one I want to mention, Dollar Tree, big move on this one, 6.42% gain of $6.90 to $114.36 as they reported good earnings and a pretty decent guidance. All right, on a year-to-date basis, here's where we sit. S&P's down 2.1%, Dow's down 2.3%, NASDAQ down 3.7%, and the Russell 2000 made it back into positive territory, up 0.9%. All right, when we come back, how much income do you really need to retire? It's not about the size, it's about the sources and many, many other strategies that I'm going to share with you. But first, let's turn it over to Jack Saban. He's got news, traffic, and weather. Hey, Jack. Welcome back to the Jon Sanchez Show on Newstalk 780 KOH. Happy Monday to all of you. Good Monday on the street. Finished up 388 on the Dow. NASDAQ rose 269 and the S&P higher by 67. All attributed to a fall in oil prices. $5.26 down to 93.35 a barrel. All right, let's hope we get a nice sustained stock market rally. Right, we got a ways to go as I shared with you the year-to-date numbers. So if that's the case, then today's topic is going to be absolutely perfect for you, which is you got to save a bunch of money. Or do you? To have a successful retirement. As I said at the beginning of the show, everybody has a magic number in their mind. I need $1 million, $2 million, 500,000, whatever the number is. But it's an absolute wrong way, in my opinion, to look at a large number like that. What you need to be looking at is the income that portfolio can produce. Okay? So I'm going to call this the biggest retirement myth I've ever heard. I just need $1 million and I'm all set. Like I said, when I got started this business years ago, that seemed like a phenomenal number. Now, $1 million saved up is nothing unusual, to be honest with you. I mean, when you look at 401ks, etc. So retirement planning is not about the assets that you have. It's about the income. But no matter how much money we have, 500,000, $1 million, $2 million, whatever the number is, we have to assign a withdrawal rule. Now, it varies for everybody. Like I told you in our firm, because of the way we manage and diversify, we're comfortable with a 6% withdrawal rate. Most firms are around the 4% mark. And when things get really lousy in the market, a lot of times advisors will cut that number down to about 2%. So we'll just kind of go with the industry norm, 4%. So I take 4% of my portfolio. That's going to be one of my sources of income. Pretty simple. You got $1 million portfolio, $40,000 a year. Cool. How about another source of income? Social Security, plus the investments. Well, there's your retirement paycheck. Social Security, if you made a decent amount of money in your job, and especially if you retire after 65 or 65 and 10 months, depending upon when you were born, you're going to be looking somewhere around high $2,000 to low $3,000 range. So let's just use the number 3,000. All right, so we got 3,000 coming in from Social Security. We have our portfolio withdrawal of about $3,000 a month. Hey, we're now up to $6,000 a month. Not too shabby. But here's one of the problems, one of the gotchas, as I call it, the inflation problem. Folks, you have to realize that you could spend more time in retirement than you did working. Why? Because through medical breakthroughs and people are taking care of themselves, we're all living longer. At least I hope I'm going to. So now retirement lasts 25 to 30 years. And then what ends up happening? That hidden I word, inflation. It begins to quietly erode your purchasing power. So $5,000 a month today that you need to live off of, probably going to need about $8,000 in 20 years. And that's why a diversified portfolio and in assets that stay ahead of inflation. You need the stock market, one of the very few asset categories that stay ahead of inflation. A lot of people don't know that. That's why no matter how conservative you are, you should always have some money in the stock market. Again, to keep ahead of that inflation number. Okay, so let's kind of summarize so far. We've got 3 sources of retirement income. We have Social Security, we have investment income, and now what about guaranteed income sources? What is that? Well, we'd love to have a pension, but not a lot of people have that offered to them anymore. How about another great guaranteed income source? An annuity. And don't tell me, oh my God, I hate annuities, I hear bad things about them. I tell you what, I challenge any one of you to call me at my office, 775-800-1801, or send me an email, john@sanchezgaunt.com, Jon, and say, I disagree with you, and I think annuities are bad. I love when people tell me that, because that means they don't understand how they work. We love using annuities for guaranteed income sources in our portfolio. And I love breaking the misconception again when someone says, oh my gosh, no, they're terrible. I heard Bob Brinker, I heard Susie Orman say, oh my gosh, they're terrible. Or I read this article about it. Yeah, whole nother story of why those people tell you they're bad. I've used them I've been doing this for 37 years in December. So for 35 years, I've incorporated annuities into my portfolios. And let me tell you, I've been extremely, but more importantly, the clients. Yeah, there's rules to them. They're not perfect. Early withdrawal penalties, and you got to understand the taxation. They're very complicated investment vehicles. They're not for everybody. But for the right strategy, right type of an account, right type of need for it, I love them. Just my personal opinion. Not going to be perfect for everybody. But I would love to educate any of you, that if you want to learn about them, please call me. I'd love to have a one-on-one conversation with you. I really would. All right, so we got some guaranteed income sources. Ooh, what a novel idea. That way we don't have to rely upon the stock market portfolio, right? That's only 1/3 of our portfolio, or 1/3 of our income. We've got Social Security, we got guaranteed income sources, and then we have the investment portfolio income. Now, why do investors run out of money, right? No one's thinking about that now because we haven't been in a bear market for any time period. But I want to highlight why retirees run out of money. First common mistake, they withdraw way too much, way too early. I'm going to go into that in a little bit more detail in a moment. Excuse me. They retire too soon, right? They think, oh, it's 62, 63. Remember not long ago, everyone, when we had more job openings, 10 times more job openings than we did jobs, and so many people were going, oh my gosh, I'm gonna retire. Because I know if things don't work out, I can always go find another job. Now it's just the opposite. People are begging to find jobs. So you retire too soon. You have that longevity side of things that I was just mentioning. And you live in 25 to 30 years. And the most tragic thing that you ever see is someone in their 70s, somewhere around there, or late 60s that maybe retired 5 years ago, and they're out of money. Regardless of the reason why. Bad investments, bad market timing, both the reasons, whatever the case may be. But that's one of the reasons investors run out of money. They retire too soon. Third reason, they ignore the taxes. I'm going to go into that in more details in a moment. Again, it's like inflation. It's a hidden expense that is out there. And most importantly, they have no income strategy. You see, again, Wall Street wants you to just say, I love telling people this, and I'll share it with you. Let you in on a little Wall Street secret. We were taught early in our career to tell you, to scare you, and say, hey, guess what, Mr. Client? You only have $500,000 in your account, in your IRA. It's going to be a bleak retirement for you, Mr. Smith. You need, you run a projection. $1 million, $1.5 million, $2 million, whatever the number is. Now, why does Wall Street do that? Wall Street doesn't give a damn whether you have a successful retirement or not, but they want you investing on a constant basis. That's how they make money off of you. But you see, they don't talk to you about an income strategy. And that's why I created years ago that risk profile. Again, it's a different way cash flow strategy. It's a different way to look at retirement income. Fixed expenses versus fixed income. Variable expenses versus variable income. They're different animals. Wall Street doesn't tell you that. Wall Street says, save a bunch of money. Stock market's always going to go up, and then take a withdrawal off of it. Stories I could give you where that doesn't work. So those are the common mistakes. You withdraw too much too early, you retire too soon, you ignore taxes, and you have no income strategy. Now, let's get to another phantom expense or hidden expense. That's some costs that you're going to face in retirement will go down, but you got a whole bunch that are going to go up. What are some of the most common expenses that people fail to account for? Number one, first and foremost, listen to me closely, it is healthcare. Now you may be saying, frankly, this is what happens with a lot of you. You don't retire until you hit 65, so you're Medicare eligible. But sometimes you lose your job, or for whatever reason, you decide to leave early. Let's say you decide to retire at 62. You got 3 years, you got to go out and pay for medical insurance. But even on Medicare, I hear this complaint from clients all the time. It's not as cheap as people think that it is, especially if you're a high-income person. So no matter where you're going to fall, whether you're going to be eligible for Medicare or you're going to have to go out and get your own personal insurance policy, it is expensive. Let's talk about another form of insurance. Something you hear the real estate boys talk about every Tuesday and Thursday. Insurance on your home, insurance on your vehicle, insurance everywhere. It's not going down, it's only going up. And when you're on a fixed budget like most retirees, that can crimp you dramatically. It's a hidden expense out there. Home maintenance, AC unit goes out, refrigerator goes out, roof needs to be repaired. That's why we always consult with our clients before they retire. Do you foresee any major home expenses over the next 5 years? Because we would rather tackle those in the beginning of the retirement and plan for it than get 2 or 3 years in retirement, income's going good, and then they go, hey, we need to withdraw $50,000 to do a bunch of home repairs. I just had a conversation with a client last week. $100,000 plus home remodel. If you've ever done a remodel, you know it starts at $20,000, and before you know it, it's $100,000, because it's like, oh, I don't want to just do my bathroom. I need to do both bathrooms. Oh, I don't want to just do those. I need to redo the kitchen and then my master bedroom, and on and on and on. So those home maintenance, home repairs can really, really come back and bite you. Oh, I don't see that as a major problem because you can control that. But here's another one. Helping children and grandchildren. Read a great article the other day, forget what publication it was in, how so many people nowadays, I'm talking people of retirement age, are now raising their children, their grandchildren. And I'm not talking having them over for a couple days. I'm talking adopting them and raising them. Using drugs, unfortunately, are involved, but helping your children or your grandchildren out, we know it's tough for the young couples that are out there right now. Hard time coming up with money to get their home. Just hard time surviving. And I know a lot of young couples that make well over $100,000 and they literally are paycheck to paycheck. It costs a lot of money to raise children. And to have a roof over everybody's head. And to save for retirement. And to pay for medical insurance and home and on and on and on. And a great stat that I'll leave you with is average healthcare costs for couples in retirement can exceed $300,000 over their lifetime. Scary number, isn't it? We're going to come back and talk about taxes is another important issue of how much income do you really need to retire. Let's wrap it up with Kristen Snow right now. Traffic Center. Kristen. Welcome back to the Jon Sanchez Show on News Talk 780 KOH. Again, another good day in the street. Up 388 on the Dow. NASDAQ rose 269 and the S&P higher by 67. Oil again lost $5.26, 93.38 a barrel. All right, we're talking about how much income do you really need to retire? Just kind of building up to this, right? Because again, there's so many hidden things out there, so many different ways that you can create retirement income. So let's go to the next one, which is taxes, right? This is another area that a lot of retirees or future retirees fail to account for. So what are your possible taxes in retirement that can eat away at your income? IRA withdrawals. So remember, for many of you, what you're going to end up doing, you've been saving all these years in your 401k. When you retire, you want to get it out of there. You roll it over to an IRA account. You start taking withdrawals. That money's never been taxed before. It's now in an IRA rollover account. Again, never been taxed before. So every penny you take out of that IRA account, it is going to be taxable to you, unless it is a Roth 401k, which very few people do. Your pensions, they're taxable. Your Social Security above a certain income level is taxable. Your capital gains, there's different tax rates there, taxable. And your Medicare IRMAA surcharges, those are taxable. So many people in retirement move from the IRS paycheck to the retirement paycheck, but the tax bill still stays the same, and you have to account for that. So you see how all these little things, the inflation, the rising cost, the Medicare, or medical insurance, the healthcare, all these different things. Yeah, we started off, making $6,000 a month, and now it just starts to get eaten away and eaten away and eaten away. What about the order that you withdraw money? This is really important also. We call this the sequence of withdrawals. I did a show on this a while back for you. Most people will do this. They'll take money, first of all, out of their taxable accounts. Secondly, they'll take it out of their IRAs, 401ks. And then third, they'll take it out of their Roth. But don't think that that's the only way to do it. Again, this is where a great advisor will work with you and say, look, this is the best way to do it. I've had some times where it made more sense for the client to take money out of an IRA account than out of a taxable account because they were in such a low income bracket for a certain year, right? Or sometimes out of the Roth, right? That's tax-free withdrawals if certain rules have been met. So don't assume anything. This is, again, where you need to work on a strategy. Market volatility early in retirement. Well, as we've touched on this one, again, sequence of returns. Two retirees have the same average return, but different timing of losses. One runs out of money, the other succeeds. It's not just the return you earn, it's when you earn it. I touched on the guaranteed income versus the market income. And then, most importantly, the emotional side of retirement. You with your time, what's your reason for getting out of bed, so on and so forth. So the bottom line is this. How much income do you really need? Every person is different. Sit down with us or sit down with a great advisor and figure this out. Figure out, again, how much you can do as far as an absolute, realistic withdrawal, whether it's 3, 4, 5, 6, whatever percent it is. Back out the taxes, back out inflation. Look at what the income sources are. Then you can make your decision on how much you can expect in retirement. Because I don't want any of you to have to go back to work. If we can be of help to you, give us a call, 775-800-1801. Have a great afternoon. We'll see you tomorrow on the Jon Sanchez Show. God bless.
Jon Sanchez is a registered investment advisor, and the opinions expressed by Sanchez Gaunt Capital Management, LLC on this show are their own and do not reflect the opinions of News Talk 780 or its parent company, Cumulus Media. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.